Thanks all for joining. I'm Ella Griffin. I'm the BCO London and South East NextGen Chair. And today I'm pleased to be joined by Vicky, Heath and Barrie David from JLL's research team. So this is officially our Q3 market update, but a little bit different from the last two that we've done in the sense that we're going to be focusing a bit more on the Western Corridor, so our southeast area. Without any further hesitation, I'll hand over to Vicky, who's going to kick us off.
Thanks very much, Ella, and thanks everyone for joining today and for the opportunity to present to you all. So just by way of introduction, Barrie and myself both work in the UK office's research team at JLL. Today we're purely focusing on the Western Corridor. I'm going to start by looking at general activity in this market area, and then Barrie's going to look in more detail at asset repositioning across the Western Corridor and the wider southeast. So we've got a fair amount to get through, but we're happy to take any questions at the end, which I think you can put in the chat as well if you want to. Let's get started. So first of all, different property companies present the Western Corridor market in different ways. So I thought it would be helpful to start off if I showed you the JLL definition. So the right-hand side is our West London sub-market. The left-hand side is the Thames Valley sub-market. We basically run from Hammersmith in the Far East out to Reading in the west, north to the M40 and south down to the M3. We have a total built office stock of about 84 million square foot. So that's smaller than both the City and the West End London markets, which are both over 100 million square feet. We do also cover markets such as Oxford, Cambridge, Brighton, etc. But we cover those as separate markets in the wider southeast. To start off, I'm going to focus on take-up and demand in the office leasing market. So the take-up of office space has seen a strong start to the year. We've reached 1.6 million square foot over the first 9 months. So we're likely to exceed the 10-year average of 1.9 million square feet, which is good going in the new normal post-COVID. And we should also exceed the 2021 peak. Take-up is focused in some core markets, the main one being Reading, which so far this year has accounted for 34% of all floor space and 26% of all deals done. In terms of the West London Thames Valley split, the Thames Valley so far accounted for 60% of all take-up so far this year. This slide looks at take-up by size band. So far in 2025, you can see we've had more larger deals. So we've seen 20 deals over 25,000 square foot, as shown by the brown and sort of lilac coloured bars. Key deals so far this year include BAE Systems, which have taken 160,000 square foot in Green Park, which is linked to the government's defence strategy. We've also seen 2 deals at Stockley Park, which are both to life sciences related occupiers, and also 2 deals at One Station Hill in Reading to energy companies. So a fairly broad occupier base in terms of these larger deals. Let's take a look at take-up by business sector. And we can see there is this broad occupier base that I've just mentioned. So the chart on the right-hand side shows the 5-year average, with TMT typically accounting for a quarter of all space taken up, with manufacturing accounting for about a fifth. And this trend has continued so far this year in 2025, as shown on the left-hand side, with these two sectors both accounting for about 46% of all space taken. Also worth just noting that life sciences is significant in this market. It accounts for about 14%, both on the 5-year average and so far this year. And also, with my sort of UK hat on, interesting to mention that the Western Corridor does have very different dynamics from like the big 6 regional markets, such as Manchester and Birmingham, where professional services is typically the most dominant sector. This slide shows take-up of office space by flexible workspace providers. I've included 10 years of data here just to show the impact of the WeWork era pre-COVID. So for example, in 2018, close to 400,000 square foot of flex space was taken up, equating to a 14% share of overall take-up. We're now down to less than 5% in recent years, with most space taken in the Thames Valley market. About 3/4 of these deals are on traditional leases, with the remainder split between landlord offer and management agreements. So far I've covered existing demand, but we also look at future demand as a way of understanding which are the growth sectors and how the market may evolve over the short to medium term. These two charts look at requirements that are being logged by JLL for named occupiers that are actively looking for office, sometimes lab and office space, within the Western Corridor geography. The left-hand chart shows the percentage of floor space required by each business sector, while the right-hand chart shows a number of inquiries that have been logged. Given what we've already seen from the take-up data, it's no surprise that the TMT sector is dominating current requirements, with a particular focus on AI companies. This sector accounts for 50% of floor space required and 40% of all logged named inquiries. Manufacturing is the second most active sector, and we're seeing a range of companies here, including food manufacturing, automotives, and engineering. Also worthy of note again is life sciences, which is a 10% share of named demand, typically focused on the West London and Reading markets. I'm now going to move on to briefly talk a bit more about the future of work and some research findings from JLL. So for these next two slides, I'm just going to look at some of the recent JLL Future of Work survey data to demonstrate current sentiment and how occupiers and employers are feeling about the office environment. So this chart is from our EMEA Work Dynamics Pulse survey, which analyses companies across the globe in terms of their portfolio strategy. So the key highlight from this slide is that those expecting portfolio size to decrease has declined significantly year on year, as shown by the beige bar for 2025. Over the past 3 years, the number of companies planning to downsize space has fallen from 57% in 2023 to 29% in 2025. It's showing that companies have made significant progress on right-sizing efforts and are now stabilising their portfolios. This is further shown by the increase in those who plan to keep their portfolio unchanged or increase in size. This may be due to cutting too much space in the immediate post-COVID environment, or organisations having to add some space to accommodate increased in-office attendance. So moving on to office attendance. This slide is from our Workforce Preference Barometer and is a UK cut of the data. The 3 pie charts show attendance by hybrid policy and the number of days of mandated office attendance. So the vast majority of UK employees are complying with their company's policy, as shown by the dark and light blue shading, with many choosing to spend more time in the office than mandated. And if you just look at the middle chart, this looks at employees that are required to be in the office for 3 to 4 days a week. And you'll see that 77% are following the guidelines, with a further 5% working full-time in the office. This suggests that for the vast majority of employees, office work provides tangible benefits, and that the office serves as a mechanism for creating healthy boundaries between work and personal life. Therefore, as companies slowly start to move away from downsizing and employees are spending consistent time in the office, this should help to boost future demand for space. Having looked at demand in the leasing side of the market, now let's look at how this impacts supply and future development across the Western Corridor. So this slide looks at immediately available supply across the Western Corridor. Some property consultancies will include space that might still have 6 months left of the construction, but we include only space that's immediately available. And as you can see from the bar chart on the left-hand side, Grade A space typically comprises 2/3 of supply across the Western Corridor. The chart on the right-hand side shows vacancy rates split by the 2 sub-markets, West London in blue and Thames Valley in purple. In West London, vacancy is showing a general downward trend, currently at 9.1%. Whilst in the Thames Valley, there has been an uptick in supply as space comes back to the market, as occupiers consolidate, move to the flight to quality, etc. And in the Thames Valley, the overall vacancy rate is currently 11.5%, with Grade A at 6.7%. Let's now look at the development pipeline. Excuse me. There's a lot to digest with this chart. It covers both new build schemes and retrofits by year of completion. It shows completions over the past 5 years, whether it was pre-let or available at completion, which are the brown bars. And looking ahead, it covers anything already under construction, so both pre-let and speculative, which is the blue bars. In addition to any schemes that may come through on a speculative basis. Quick sip of water a moment, sorry. Thank you. So in 2026, we have some space in light green, which we deem has minimal barriers to start on a spec basis. For example, this may already have planning and funding in place. Then in 2027 to 2028, we have some space with multiple barriers to start. shown in purple, may still need planning or funding. But the developer has expressed that they plan to bring the scheme through on a spec basis. With regards to completions, 2025 will only reach around 100 square foot. Excuse me. I'm just going to pause and have a drink of water. Thank you. We'll have to hand over to Barrie. Right, let's give it another go. So in terms of completions, 2025 is only going to see 100 square feet, which is going to impact on the supply of good quality space. We can also see a clear supply shortfall from 27 onwards too, and even 2026, with 49% of the space underway already pre-let. Just thinking back to the future of work slide I showed on portfolio right sizing, these occupiers need to be planning 2, 3, if not 5 years ahead, depending on the scale of their move, as securing a pre-let may be the only viable option. Let's just take a more granular look at what's actually on site. We've got 10 schemes currently underway, 6 of which are new build, and you can see some are fully or part pre-let with the dark blue shading. The largest scheme underway is 3 Copper Square and Brent Cross, which is part pre-let to Sheffield Hallam. And the beige bar you can see is the only occupied development by Halion, which is part of GlaxoSmithKline in Weybridge. Water. So the demand for high quality space as offered by pipeline schemes is driving rental growth in some markets. So let's just move on to look at the prime rents picture. This shows some of the key markets across the Western Corridor, with the actual headline prime rent in beige on the left-hand side, and the year-on-year rental growth in blue on the right-hand side. The demand for well-located, good quality space remains healthy in a number of towns across the Western Corridor, and we have further growth forecast in the best locations. Farnborough and Basingstoke, both Thames Valley markets, have seen the strongest rental growth so far this year across the Western Corridor. But some markets, mainly in West London, are seeing headline rents begin to edge down. These are markets such as Ealing, Hammersmith and Staines. These markets are typically seeing office stock going for alternative uses, particularly residential. But that's not to say that if a best-in-class building came forward in these locations, it wouldn't command a top rent. And Barrie will cover this in more detail in his section. So for the final part of my section, I'm pleased to say, because I'm about to lose my voice, we're going to move on to just briefly talk about the investment market. So as shown by the left-hand chart, we've seen subdued investment activity this year, way below the 10-year average and also some 60% below the 5-year average. Just to point out that in 2016 and 17, we saw some large business parks included, which accounted for the spike in volumes then. The right-hand chart shows prime yields. These have remained at between 7.5 and 7.75 this year, and are forecast to do so into next year, before we expect some inward movement as positive signs of renewed investor confidence translates into increased activity. We've undertaken some top-level analysis this year looking at intended future use of office purchases in the Western Corridor and the wider South East, and this clearly shows a repositioning of some of these markets. In the Western Corridor so far this year, we've had 37 office sales, of which only 23 will stay in office use, with the majority of others going to residential. And across the wider South East, we've seen 77 transactions, with 40 staying as offices, 30 going to residential, and the remainder going for uses such as life sciences, retail, self-storage and industrial. And this is a very good point to hand over to Barrie to talk about repositioning in more detail, and hopefully he'll have more voice than I have. Over to you, Barrie.
Thank you very much, Vicky. Well done for getting through those slides at the end. I was slightly worried I'd have to cover those as well. So for my section, I'd like to look at the loss of office space within the Western Corridor and the repositioning opportunities that it may present. So move on to the next slide. Vicky's steering. So how much space has the Western Corridor lost? So despite permitted development rights being introduced in 2014, space was still being added to the market at that time, most notably you can see in 2018 and 2019. However, since lockdown, the amount of office space has declined, and since 2019 we have lost 6 million square feet across the Western Corridor. Vicky mentioned earlier how the world of work is changing, and we saw many companies cut back their office requirements in the post-pandemic environment. I know that though it has eased, you can see in 24 and 25, the amount of office space across the Western Corridor continues to decline. The pressures on alternate use, especially in West London, are great, the most significant from residential use at the moment. So within the Western Corridor, we've seen the rapid evolution of the market in rental terms. This is prime rents, as Vicky sort of showed on the map earlier, especially over the past 5 years, increasingly a tale of two markets. As the previous slide showed, that some Western Corridor markets are under considerable pressure from a variety of alternate uses, such as logistics and warehousing, locations such as Staines and Hounslow in particular. Alternate use such as residential, but also logistics and warehousing around Heathrow, and more recently, data centres in West London. Consequently, office market rental growth has been negligible and even negative in the case of Slough. Whereas there are markets seeing significant rental uplift. I've expanded the sample here to a few southeast examples. Oxford, Cambridge and Reading are to the fore and benefiting from the post-pandemic growth in life sciences and technology, and also improved local infrastructure. These are towns and cities in their own rights within their own sphere of influence, and we can see by the strong rental growth attractive to office occupiers. Here are a few examples that showcase the high quality space that has recently been built across the Western Corridor. Station Hill at Reading in the bottom left is an excellent example. Over the past 10 years, Reading has seen improved infrastructure provision, the remodeled railway station, and it's also the western terminus for the Elizabeth line. Also, as Vicky mentioned earlier, Reading is the most active market in the Western Corridor. And although the scheme is only recently completed, Station Hill is commanding new rental highs within the city. Also, we need to highlight the quality and sectoral mix of the occupiers within these examples. Most are global companies from a wide variety of business sectors, and they've chosen to locate in the Western Corridor. The Western Corridor also has the highest density of suburban and out-of-town office parks within the UK. And it's these specialist campus clusters such as Foundation Park in Maidenhead and on a larger scale Green Park in Reading that are also seeing healthy transactional volumes. It is clear that both location and quality are of vital importance to new office development. So moving on to the next slide, if we can. Focusing purely on office parks for the moment, there are many across the Western Corridor on both suburban and out-of-town locations, as I mentioned. The primary driver for successful office park operation is single ownership, presenting a unified master plan to control the environment of the park itself. Even though it's outside the Western Corridor, I've added Canary Wharf here as an excellent example of a single ownership park. Single ownership allows office parks to adapt to change, in particular with refurbishment schedules and how to provide comprehensive amenity and transport provision. When ownership is fragmented, decision making can be hampered by delay and a lack of consensus, and it can be more difficult to agree on crucial capital expenditure. So we've seen what the current market is looking and how the loss of space and the opportunities there. So what is the focus, as we've seen, is on well-located, good quality space, but what does the future look like? We've seen that there's been a noticeable loss of space within the Western Corridor and there's an increasing divergence between locations across the region. Is retrofitting the method to refresh office buildings to create sought-after buildings in sought-after locations? The key pillars for consideration are place, sector, asset, and space. Place is vital. You can have a grade A building in a grade B location, but it is unlikely that its true value will be realized. Place the same building in a more favorable location and the rents achieved will be higher. Sector. Encourage clusters. We can see from the strong research and development clusters in Oxford and Cambridge that these cities are poised for success. Additionally, within the Western Corridor, it has been traditionally the home of the IT sector in the UK. There is the opportunity for spillover in terms of life sciences from central London and Oxford. Companies will be able to utilise the economic and demographic benefits of the Western Corridor. Asset, as we've seen earlier, the access of good quality assets in both city centre and out-of-town locations. And finally, space. Buildings need to work in their location. A successful building will enhance the cityscape, but also attract tenants and employees. But in terms of refurbishment and retrofitting, what is the difference between the two and what impact does it have on the existing building? So I've got sort of like nice explanatory slide here. As the slide shows, going from left to right, refurbishment is a minor update to the building, perhaps repainting the walls or replacing the carpets. We then move along the retrofit scale from light to deep, with a deep retrofit towards the right, comprising a back-to-frame upgrade of the entire building, with it being unoccupied whilst the retrofit is underway. Finally replaced to the extreme right of the slide. This is where the existing structure is demolished entirely and replaced with a brand new building. When Vicky was talking about new build in the development pipeline slide earlier, this is a new build scheme where it's categorized as a replacement. However, these schemes, towards the right-hand side, the deep retrofit and the replace, these are inherently complex and vary greatly on scope and value. And as a result, construction costs and timings will vary greatly. However, does a rising tide lift all boats? With the amount of office space that's been lost, there will be further risk to stranded assets. For example, the wrong building in the wrong location, or in the case of the Western Corridor, potentially both. As I mentioned earlier, the key aspects are asset and place. In terms of asset, there's a more individual approach for an owner of a building. You may look to improve the quality of the asset, for example, upgrade the office space from grade C to grade A, or it may be more financially viable to reposition the asset, for example, change the use from office to residential or hotel use. Place is a more macro element, requires collaboration between stakeholders. We've already seen some public sector involvement, such as the purchase of assets, e.g. shopping centres, that can help reinvigorate city centres. But the improvement of place is more a complicated and longer term option. Owners and operators of buildings will be looking for a more shorter window of opportunity in terms of retrofitting or repositioning to avoid the stranding risk. However, although, as we mentioned earlier, place as a long-term issue, place is as important in terms of the viability issue. Repositioning takes capital, and the return on capital varies by sector and by location. On this chart, with notional years to break even on the y-axis and prime rent on the x-axis, we've tried to ascertain those locations further along the viability curve where the break-even period is lowest. Those locations with higher rents have a shorter time to break even. Retrofitting or repositioning in locations such as Oxford, Cambridge and Reading to the right of the chart could take 2/3 of the time to break even to locations such as Slough and Staines, which is towards the top left. This increases the pressure on office markets in locations such as Slough and Staines, where the loss of office buildings to alternate use is notable, and further highlights the viability challenge across the markets of the Western Corridor and the South East. A further consideration for both retrofitting and refurbishment is construction costs. In the post-pandemic economy, UK inflation has risen significantly, and this has impacted many sectors. Consequently, the cost of labour and materials are considerably higher than 5 years ago. Therefore, for this chart, we viewed BCIS data and adjusted these numbers to a net internal area. Although the southeast, you can see, is well placed here compared to London, it is still costing on average £314 per square foot to build a new office scheme, higher than a number of many of the key regional cities in the UK. Consequently, it could be argued that the prime rents seen in the slide previously and the map shown by Vicky could be regarded as viability rents, as in it is viable to commence construction of an office scheme. The higher the rent, the more viable the opportunity, and many of those assets in locations with the lowest rents at a greater risk of stranding. So to summarize what I've just sort of been talking about, we can see there's a wealth of opportunities for repositioning, retrofitting in both city centres and office parks across the Western Corridor, either by improving existing office stock or outright conversion and redevelopments. We're also seeing the conversion trend increase, especially in West London, where competition for space is intense, particularly from residential use. However, development rates remains constrained by viability headwinds such as subdued rental values, combined with the recent rise in building costs. Good quality space will continue to attract occupiers, and those locations where structural vacancy is low, the retrofitting opportunity for office space could yield major returns, as we've seen in those places such as Oxford, Cambridge and Reading. But roughly 80% of existing buildings will still be extant by 2050. The rate of repositioning and retrofitting therefore needs to triple, we've kind of worked out roughly, to deal with the impending stranding risk. So to conclude my section here, a question we're sometimes asked is how much space will the Western Corridor lose? What is the right size for the market? It's difficult to put an actual figure on it, but the market will continue to adjust. And current evidence suggests that demand for well-located, good quality space suggests an ongoing requirement for such space. Therefore, it's unlikely that the southeast will need less. It's likely that it will need less overall space, excuse me, but more space of a better quality. Although this remain highly variable by location, the more successful locations will continue to grow. As we examined beforehand, retrofitting and reposition will help, firstly by improving the quality of standing assets, but also by helping to create more holistic places and embracing office and other land use requirements, as we've mentioned, data centers and office like that. We've seen significant changes in the Western Corridor office market, particularly over the past 5 years. Increasingly, the focus will be on good quality space, and this can be boosted by improving standing stock, and that will better position the Western Corridor market for the next wave of macro and sectoral trends. Thank you very much. That concludes both the chat from myself and Vicky. If you'd like to put any questions, hopefully Ella will forward those to either one of us or try and answer them for you.
Thank you so much, guys, and it was very, very interesting and a bit different from the market updates we've had before. So thank you for bringing something fresh. And Vicky, I'm glad to see that you're still with us there. It's
Yes,
always the
I must
way.
apologise. Sorry.
Always the way. So guys, if you do have any questions, please pop them in the Q&A box. We've got some at the moment to go through. So I suppose a question from myself to start us off. You talk about the retrofits that are being undertaken. Are you seeing many deep retrofits being undertaken? I suppose it's something commonly seen in London. A big push for the carbon, and obviously we've seen difficulties or trying to maintain heritage buildings, etc. But I wonder, is that happening to the same extent outside of London?
It's interesting. I think if you go to the Western Corridor, there's still that element of the viability. I think certainly we've seen. I mentioned Station Hill. That's a new build scheme, but that's quite rare. So obviously, I'm not sure that slide sort of showed it. Retrofitting is cheaper than new build. So I think in this market, I think we're seeing more retrofits than new builds. But the market is relatively quiet outside London. That's true for the regional office markets, Bristol and Birmingham as well. But then oppositely, you go to Oxford and Cambridge, where it's got the life science, and I think the pipeline is a lot more active there. So it's very sort of variable. But certainly in the Western Corridor, we're seeing more retrofits than new builds. But it's slowly getting there. It's not what it was sort of before lockdown, where there was significant, quite a lot of space. We're down to, I think, our space under construction is about 1.5 million square feet, of which the majority is retrofits rather than new builds.
Yeah.
Okay. Thank you. Another question here from Sophia Wilson. Have you seen commercial office that are ESG retrofit led, obtaining higher rents?
Yeah, I don't know whether we can say that just for the Western Corridor, but on a sort of broader UK level. A lot of the new schemes that are coming through do have very high levels of ESG credentials. So be it neighbours 5-star or outstanding BREEAM, 100% electric, etc. So those buildings typically are commanding the highest rents. I would say it's unusual nowadays to see a new scheme come through that hasn't got excellent ESG credentials.
Yeah.
So it's a bit chicken and egg maybe, but I would say that that there is evidence that you get the higher rents because those are the buildings that are coming through. Now those are the best buildings that are coming through. So we did some analysis a few years ago now about whether rental premiums were paid for. That was based on BREEAM ratings and EPC at the time, because that was the most available data. And it did show that there was a premium that was more based around central London offices.
Yeah, I think it's a bit of a given in London for sure. But I suppose our prospective clients, buyers, they find that as an important piece.
I think
ESG
so.
element as much as anyone in the city would, because obviously I think most people, they have a sustainability aspiration, whatever that might be. They seems that they target as much as they can get.
Yeah,
But
yeah.
whether that's the case, I mean, this is coming from some of the work that I do, which is more, warehouse space where you don't really need. There's not an appetite for a sustainability badge or anything.
Mm.
But yeah, is that the case in?
Yeah, well, we do a lot of tracking, for example, of companies that are committing to science-based targets. So obviously, from the occupier perspective, if you're committing to science-based target initiative, then you're committing to occupying a space that does have strong ESG credentials. So I think that's slightly driving it in terms of what occupiers want. Obviously, the landlords and developers need to offer. So a lot of our analysis is around what's being driven by the occupier as well. And although there's been a lot of noise around it's falling down the list of priorities, but I think, to be honest, it's still right up there for a lot of corporates. So and also developers who've made those commitments as well. So it's
Okay, another question then. What types of tenants and occupiers are typically attracted to the Western Corridor? So I suppose what is the target market as well as who ends up being those that are drawn to the area?
Shall I go first, Barrie?
Yeah, go for it.
I think it is. I understand it is very different from like the Manchester, Birmingham, etc., where it's very strong with professional services and legal and banking and finance. The Western Corridor is much more like the TMT, so technology and telecommunications. Very strong manufacturing base still now. So, and when we say manufacturing, we mean companies. So it could be someone like, I don't know, like Coca-Cola, so like drinks manufacturer. They aren't actually doing the manufacturing in the Western Corridor, but they might have an office sort of thing. And increasingly we look at the requirements, also life sciences. So some of the requirements are for lab and office space now, rather than just office space. And we are seeing some offices that may come through now with a lab element rather than just offices. So pretty broad tenant base, but less of a focus on professional services than you might see like in London and the regional markets. So I don't know whether Barrie's got anything to add.
No, I think you covered most of it. I just says, yeah, it's been probably the IT centre of the UK for probably about 20, 30 years. Interestingly, if I could say, in the last sort of 6 months of data, we have seen more life sciences companies come out. And that could be they're coming out from central London, or also they might be coming out from Oxford as well, because Oxford, as it gets more expensive, I think you might see, because with the sort of element I was talking about, sort of stranding risks for that. There are some really good buildings and good sort of locations, and lab, sort of dry lab space may work in some of those sort of suburban office parks. And obviously, given that if they're empty, it's a lot cheaper alternative. So I think it's sort of life sciences coming to the fore, but it's always been sort of IT, really.
Another question. Can we understand whether developers are getting funding to deliver those deep retrofits in the Western Corridor?
Oh, that's a. I imagine they would have a development partner before. So I imagine they would go in partnership with a development partner before proceeding with the scheme. That'll be one of the processes going through the pipeline. If probably is a deep retrofit, they probably would need planning, and so part of that would be either doing it themselves or getting a development partner to make the scheme work.
Yeah, because we sort of rate the likelihood of whether schemes will start on a speculative basis, and a key part of that is that it actually has the funding in place. So we have a lot of schemes in our sort of broader database of pipeline schemes that obviously have a developer in place, but they aren't yet in the position to actually start, so they don't have the funding, or they might not have the planning permission that's needed. So I think when you look at viability, again, that's it's critical, obviously, that you've actually got the funding to bring these schemes forward.
So when Vicky was referring to the charts, the development pipeline, these are schemes that are sort of rated sort of like the high end. So they've got most of these 80% of those variables before we kind of consider it, because you can, any scheme can be planning, have loads of, but potential. We focus on those more probables than the potentials, if that makes sense.
Yeah, apologies if this was one of your slides, but have you seen a change in the amount of schemes that are getting that getting that investment?
I think that's one of the key issues at the moment, is the funding issue. I mean, I think the viability makes it not difficult, but the numbers really need to stack up. We certainly see it in the regional cities. Yeah, the prime rent is almost the viability rent. If you're forecasting it ahead, trying to work out what the building, it's the prime rent is almost the viability rent. So it's increasingly difficult because of the rising construction costs and labor costs and things like that. It's increasingly difficult. Hopefully, with the calmer economic waters, or at least an interest rate fall before the end of the year, it'll make it slightly easier. But it's the key thing is getting the funding, and that is still quite difficult.
Yeah, I suppose just a question that comes to mind is manufacturing is obviously quite a big sector. Was there any kind of reactive movement from the tariffs from the US earlier this year? Did that shake anything up, or is it too soon to tell, or not really?
Probably all three, Ella. I think that's interesting. I think it's probably too early because they're at the start of the year, and given how long a lease takes to sort of work out, most of those schemes are already in place. I think it'd be interesting to see sort of if we rejoin you this time next year, and you
Yeah.
ask us the same question. I think in that time the window would be long enough to say, actually, for example, Vicky's example of Coca-Cola have retrenched back to the US. They've shut their sort of Reading operation. They've
Yeah.
gone. That would be interesting to note, sort of the real global operators, or the US based operators, where they've retrenched back to the US. And things in terms of manufacturing, it depends. On the trade deal, I think it's sort of 10% might be 10% across the board, but obviously for some that's higher, and for some it's lower. So I think that's a real sort of a good question to pose for us to answer better for you next time.
Yeah, one for next year.
I think also that, I mean, the slide I showed on the active requirements, those are named inquiries that are active in the market at the moment. So manufacturing is still a significant chunk. So maybe they may not have made their final decision, but in the meantime they are still actively looking. So it's just, as Barrie said, it takes time for everything to, property market is not fast moving, so it takes time for stuff to filter through. But let's see where we are in 12 months' time.
Okay, I'll try and remember that question for you this time. I get a few more questions. Do you see quality amenity spaces more and more important to workplaces in the Western Corridor?
Yeah, I think, and probably not just the Western Corridor. So I showed a couple of slides around sort of future of work research that we do. And there is additional information in those reports around amenity provision in offices and how important it is for people coming into the office. There is the argument it might have gone too far, that, what do people actually want from their office space? But it is important in that making people to want to come into the office, and the figures do show now that people are actually coming back into the office. A lot of people working more days than they're mandated to be in the office.
Yeah, that's a really interesting piece of research, actually.
Yeah, so all of that can be downloaded off our website, I believe, if anybody wants to go in and have a look.
We'll share these slides as well. People can deep dive a bit more. I suppose with, Barrie talked about the attraction of the cities that within the Western Corridor, Oxford, etc., spaces where it's not like a business park that you might think of in a typical Western Corridor sense. You don't need to provide, I suppose, as much amenity when you're, you don't need a staff canteen or something if you're in the middle of Oxford. Is that something that is true?
Yeah, I think I think Oxford is kind of a good and kind of bad example, because the middle of Oxford, similar to Cambridge, old university city, development extraordinarily hard. Most of the most of the city centre is listed. You can't touch it, so hence why you see a lot of suburban out of town office parks.
Mm.
But I think the more successful ones, as I said, are owned by one operator. Then they can improve that. It's not just sort of like a bus from the city centre type thing. It's actually getting people to go on the park and sort of stay on the park, and that's a slightly different element to sort of just one office building in sort of in London or Reading, for example. I know, if you take Station Hill, it's got a slightly different amenity provision. You're trying to bring people to the office, but at the same time, you don't want to lose too much of your space within that office building that you're giving it to amenity where you could actually get in, lease it as a normal floor. But I think in terms of sort of the Oxford and Cambridge examples, they don't have certainly the infrastructure sort of like public transport that they do, say, in central London. So you have to offer something slightly different. So the transport connectivity, or allow people to kind of walk there or cycle there, or and things like that, and provide almost a shop as well, as because they'll be there for the whole day. So it's a slightly different element when you're looking at amenity, and if you can control that whole environment, that and then that allows you to do it at the right time. Your refurbishment scheme or your amenity provision can be done to benefit the whole, not just a single building within that, which then works for everybody, if you see what I mean.
Yeah, a few more questions are still coming in. So it's interesting that Edinburgh and Bristol have higher construction costs than the southeast. Do you guys have any information as to why this might be? Maybe a bit on the spot as a question for now, but maybe one we can get passed back to Tony, who's asked it, if you're not sure right now.
As I'm going to pass that back with the straightest of bats, that was BCIS data that we use. So possibly it may be sort of the availability, that there might be slightly smaller cities, so the availability of labour is slightly, and you have to pay more to get the labour to construct your office building, is possibly an example. Without interrogating the BCIS data more thoroughly, I can't give a more thorough answer than that, I'm afraid.
Right, one to explore, Tony. There we are.
Sorry.
No, we'll keep going. So this person has written, I guess data centers are the key sector for obtaining rents in the Western Corridor. Do you predict this to only increase in the next 5 to 10 years? Given funding is easier to obtain to build these data centers, they prefer to underwrite loans on the lease than freehold of these areas.
We are not data center experts. Although we do, again, which you can probably get off our website, we do have a data center team, obviously, and they have done some research quite recently, which I think is at a mere level on the future of data centers. But I wouldn't want to speculate on that question. I would have to pass it on to someone in our data centers team who'd have a more educated answer.
Yeah, Daniel Thorpe, who heads up our data center research. I'm not gonna. I don't know enough to answer that sufficiently. Apologies.
Yeah. Fair enough. Well, yeah, I think. Correct me if I'm wrong, but I don't believe people put offices with their data centers. It's more of just an FM, so it's not like a warehouse type where you might have your office adjoining your manufacturing facility or your warehouse facility. Doesn't seem to work in the same way, interestingly. But
yeah,
maybe in the future, 5 to 10 years, that could be. Okay, I have one more question on here for now. If anyone else does have any further questions, do go ahead, but I'll just read this last one out for now. So, with limited amenities often available in out-of-town office parks, such as a seemingly very quiet Thames Valley Park in Reading, and often a reliance on cars given limited transport links compared to London, how are you seeing occupiers convincing people to come into their offices and impacting continued viability of these styles of offices?
I think office parks are because there are some occupiers that still have a car-based workforce, so that we're not kind of saying that all office parks are going to be there. There's still house builders and stuff like that. They'll need a car-based workforce. So I don't think that we can cast it away completely. But then I think you can look at the repositioning opportunity within that. So health centres, even sort of repositioning to sort of last mile logistics and stuff like that. I think there's use for the space. It just might not necessarily be as much office space as we had previously. So I think that's how I'd position that one.
Yeah, it's almost because it's happening at the moment. It's almost too early to say, but it's looking at some of these companies are consolidating or moving at the moment. Are they moving from these parks that are maybe not in single ownership or don't have the amenity provision? Are they moving to those better amenitized, is that a word? Places. So yeah, and I think through our survey work that will come out over the next few years in terms of what's happening. But like Barrie said, a lot of these are great repositioning opportunities. So
Okay, guys, if there are no more questions, then I'll say thank you very, very much to Vicky and Barrie for their time this afternoon. It's been very interesting. I think lots of people are keen to see those slides and pick through them in a bit more detail. So thank you again, guys. Thank you from
Thank you very much.
everyone who's attended. We'll also put this recording on the YouTube channel if anyone wants to watch back or recommend it to any other members. But thank you very much for your time, everyone, and enjoy the rest of your day. Thank you, guys.
bye.
Bye.